Hello, everybody. Today it will be my 25th lecture series, and I'll be having a session on money market. Now, I've not mentioned that it will be part one or part two, but I will. There will be a series of lecture on the money market. Then we will go into the area of capital market. Actually, there are two types of market which are actually in totality. If you see the larger picture of the economy or the macroeconomic area, then you'll see there are two types of market which are prevalent in any economy, whether it's Indian economy, whether it's economy in the overseas like in USA, in the European country. We've got mainly two economy, two markets in the economy which actually operates. Like one is money market, second is capital market. So we will start with the money market. Why not capital market? Because money market is actually a kind of is a kind of a market where you will see lots of instruments which are already prevalent prior to capital market. Means when the capital market was not introduced, capital market is something like when you are having when you are having a capitalized economy, or a capitalistic economy where there will be where the goods and services are being produced by the farms, and there will be promotion of the entrepreneurs. But in case of socialist economy or a mixed economy where the farm performance are actually regulated by the government, we all know that what is the socialist economy or the communist economy or the communist part of the economy. So this is very important to understand that what is money market and what are the instruments of money market. So this will be my part one lecture series of the money market. We will continue with some parts also, because it is not possible to cover all the areas of money market in one single session. So money market is actually a component of economy that provides short-term funds, and the money market actually deals in short-term loans, and generally for a period of 1 year or less than that. So a short-term securities become a commodity. The money market become the component of the financial market and of assets involved in the short-term borrowing, lending, buying and selling, and with original maturities of 1 year or less than that. So for example, if you are lending for 6 months, if you are borrowing for 9 months, if you are taking a loan for 1 year, the 1 year, 1 year or less than that, then that kind of scenario is called the money market, and those are operated in the money market segment. For example, if you're investing in the stock market, then obviously it is liquid in nature, but the investment is of a long term investment. For example, if you're buying a Reliance share today of 100 shares, then obviously then you are investing, or X limited company, any company, then obviously you are investing it for a longer period of time. So there are actually several money market instruments. And what is these instruments? I will come in details what are the instruments are. The money market instruments in most of the Western countries, like in the US or in the EU countries, the European Union countries, where it includes the treasury bills, commercial paper, bankers acceptances, deposits, certificate of deposits, bills of exchange and repurchase agreements, federal funds and repurchase, and short term mortgage and asset backed securities. So these are kind of instruments. These are various instruments. These are one of the these are main areas of instrument which falls under the area of the money market. And these are the very important instrument, not only for the private entities, but these instruments are also being floated by the government. For example, treasury bills. For example, the commercial bills, mainly the treasury bills. Treasury bills are issued by the federal government. For example, we also issue treasury bills. Like in India, government of India issue treasury bills. Government of West Bengal issue treasury bills, or any other state government issue treasury bills through Reserve Bank of India. So there is a mechanism. I will come to that point. Now the instruments are bearing different maturity period, and they are based on various currencies also. So if there is a kind investment in kind of instruments, then always there is a risk. This risk is called credit risk. For example, if you are going to any bank or financial institution, for the purpose of borrowing. For example, you are going to State Bank of India for home loan. You are going to purchase a property. Then obviously you are applying for 10 lakh or 15 lakh or 20 lakh loan, home loan. So in that case, what happened? There is a credit risk for the bank to provide you the loan, because whether you are credit worthiness or not, the bank is going to check. It is an income. For example, if they are providing you a loan, so the interest that they are earning on the loan which has been provided to you or me is an income from them. It will be charged in the side of the income, and that loan is considered to be as is called as asset on the bank side. But for me, if I am taking a loan from my house property, or building a loan or taking a loan for building a property, or purchasing a flat, or purchasing a car, or purchasing a big size television which actually costs around 10 lakh, 1,50,000 or 2 lakh, then what is that kind of loan? Those are actually consumer loan. Then that is a liability for me. That is an obligation for me to repay the loan along with the interest. Because see, if anyone is giving you a loan, then obviously there will be some charges for that one. So the charges is the interest. Similarly, being an individual, I can take loan. Being an entity can also take loan. For example, if you are starting a business, you can go for a Uddam loan or a small business enterprise loan. Big industry houses go for borrowings from international market. They actually approaches the various banks to provide them the loan, the business loan for expansion loan, and that loan has to be repaid to the bank. So this and because of that, I've told you that it is based on various currencies. So any company which is a growing company can have a fund from abroad. So and the fund will maybe in the dollar, maybe in euro, or maybe in pound, or whatever currency is seeking the loan. So a market can be described as a money market if it is composed of a highly liquid and a short-term assets. And the money market funds typically invest in government securities, in certificate of deposits, in commercial paper of companies, and other highly liquid and low-risk securities. Money market is actually concentrated on a very low-risk side. Means the risk is very less. So we know that how the market operates. Why in capital market the return is very high? Because the risk which has been undertaken is very high. So if there is a high risk, then there is a high reward. If there is a low risk, then there is a low reward, low return. So in this case, money market is a very safe place for the investors who are trying to invest in GSEC, we call it. That is the government securities. I have mentioned you in my previous lecture series about the national pension system in NPS. So in NPS, there are three categories. One is the equity, another is the corporate bonds or the bonds, and another one is the GSEC or the government securities. So you will invest, that portfolio is divided into three categories. The four most relevant types of money are commodity money, fiat money, or you call the fiduciary money, or which is called check or bank notes, and the commercial bank money. Now, commercial money relies on intrinsically valuable commodities that act as a medium of exchange. Fiat money, on the other hand, gets its value from the government order. Now, money market, which provides the liquidity for the global financial system, it is a very strong area. See, because of the failure of the banks, we have already seen in what happened in 2008. Throughout the globe, we have got a financial crisis, and because of where it hits the money market, where it also includes the asset-backed securities and mortgage-backed securities. So I'll come to the later point why it is very important to understand the money market instruments. If the banking system fails, then the entire economy will fail, and the banking system is the main fundamental pillar of the money market. So money market, which actually provides the liquidity for the global financial system, including for the capital market, as well as a part of the broader system of the financial market. So if you talk about the financial markets, then it is one of the important area that the money market is. So I end with the session for the part 1 today, that the money market. We will go into the deeper aspect of the various instruments, how it works. For example, what are the participants what is the function of the money market, what are the instruments which are involved, what crises it can bring, what are the opportunities for individuals or the organization to invest in the money market and to get the return out of that. So we will come up with various lecture series where I will mention about the money market as a whole. Thank you very much for joining.